Guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from One Market in San Francisco. This make-or-break hour begins with the outlook for stocks. 24 hours after the Fed signaled interest rates could be much higher for far longer than the markets thought. That surprise setting interest rates higher, stocks lower, and that dynamic, as you probably know by now, continues today. There's your scorecard with 60 minutes to go in regulation. Stocks in the red throughout. Not significant losses, but nonetheless weaker across the board. The Dow dragged by Cisco today after that company announced it would buy Splunk for almost $28 billion. And speaking of tech, NASDAQ, the weakest of the three majors following the Fed decision and Chair Powell's comments. NVIDIA and Amazon among the weaker names today. I did mention yields to you. They are the real story of this day. They hit fresh cycle highs across the curve, and that's probably taking a toll on tech as well today. It does take us to our talk of the tape, whether the Fed just upended hopes that the rally in stocks might soon resume. Well, let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, back with us today. It's good to see you. Is that what happened yesterday? Did the Fed do that?
I think that the reality that higher yields is definitely setting into this market has been one of the things that has surprised us the most this year, this ability for the market to shrug off a tighter Fed and higher yields. But I think now we're at the point where the market looks around and says, hey, maybe we won't get those cuts in 2024 as early as we expected. And if we look back when we traded to the high back in July, you were trading at 20 times forward for the S&P, 33 times on the NASDAQ. And so that was a very full and rich multiple if you weren't going to get support from the Fed. So that was the message that the Fed gave yesterday, which is why we think that these interest rates have really now started to weigh.
Was this more hawkish than you expected?
No, we expected this outcome in the sense that we did think that you would see those 2024 rates start to move higher in the dot plot. That's certainly what we saw. It drifted higher by 50 basis points, which really just said that the Fed is saying that just because inflation is moderating, if we're seeing higher growth, that means that they cannot cut rates simply because the risk is that inflation could come back. And so if we think about the most bullish scenario for markets, it was that we could get good growth, inflation would moderate, and the Fed would be incrementally easier. If you take that last part out, it just means that valuations can't be the sole upside driver of this market, and we need earnings to really be the thing that kicks in to drive markets higher.
I mean, it's interesting. It seems as though the biggest problem you could argue for the Fed at this very moment is not necessarily the level of inflation. It's the level of economic growth. Yeah. Much stronger than they had even expected it would be.
Very much so, because if we go back to the Jackson Hole meeting in 2022, Powell said that a period of below-trend growth would be necessary in order to get inflation back to their 2% target. That's what they forecasted in their S&P in their SEP all this year, and that simply hasn't materialized. So it's not just about what the inflation reading is today, it's what the inflation reading is in the next 6 months or 12 months. So they are concerned that if growth is above trend, that would cause a reacceleration in inflation, which is why they don't want to talk dovish, because the risk would be then that inflation would reaccelerate, and then they'd have to do a lot more.
But do you think a risk of recession is a higher probability at this moment because of that more hawkish tilt?
I'm not sure if it's necessarily a higher probability just because what's 25 basis points of an incremental difference. We think that there is still risk of recession in 2024, but the timing still remains highly uncertain. There was so much expectation for it in 23, but we're just now starting to see the bite of higher interest rates. So look at some of the housing data starting to roll over again. It will be really interesting if we start to see things like new home sales roll over, given where interest rates on the mortgage rate is going. So I think overall, we still don't think that we are ready for an imminent recession. We think it's still more of a 2024 question. And eventually these higher interest rates will bite, but we simply haven't seen the evidence of it yet.
So the question is what to do now if you're an investor after the Fed decision. I want you to listen to what Jeffrey Gundlach of Double Line, Cameron, told me yesterday about what the ideal portfolio might look like right now.